The economic war between the two superpowers is escalating to a fever pitch. What will America do in response to China's brazen challenge? The Treasury Department has announced an unprecedented increase in tariffs on American goods imported into China, from 34% to a staggering 84%. In response, President Trump has promised to impose a new 50% tariff on Chinese goods, bringing the total to a colossal 104% on imports from China. China has retaliated by announcing an increase in its tariffs on American goods to 84% in response to the latest U.S. actions. On April 9th, President Trump suspended most of the tariffs imposed on U.S. trading partners for 90 days, a decision that U.S. stock markets reacted positively to. The economic battles between China and the U.S. are intensifying, and the delay in settling disputes is clearly not in China's favor. The Trump administration has not only maintained but also increased tariffs on Chinese goods, raising them to 125% from the previous 104%. China was quick to respond, raising tariffs on American products to 84%. However, Beijing didn't stop there, preparing a trump card for Washington that could fundamentally shake American stock markets. According to some reports, the Chinese government is considering dumping its colossal holdings of U.S. Treasury bonds in response to the aggressive tariff policy. Amid escalating tensions and trade relations between the world's two largest economies, Beijing is reportedly exploring the possibility of selling between $900 billion and $1.1 trillion in American debt obligations. This move has already been dubbed a trade atomic bomb, throwing not only Washington but also the Trump administration personally into a state close to panic. But what does this move really mean? Why is China raising the issue of selling bonds? And why are American stock markets demonstrating such a rapid decline? The growing tension in economic relations between the two largest global powers is forcing a closer look at potential scenarios that could destabilize the global financial system. At the center of attention is the prospect of China reducing the volume of American bonds in its reserves. Until recently, such a move seemed unlikely, but the escalation of the trade conflict that began in the spring of 2025 has forced a reassessment of previous forecasts. Information that has appeared in the public domain indicates that the Chinese financial authorities have been instructed to reduce purchases of American currency. At the same time, there are reports of a decrease in Chinese investment in U.S. government bonds. Such actions may indicate that Beijing is preparing to use a powerful lever of pressure in response to the economic policies of the Trump administration, which seeks to limit China's economic growth through trade tariffs. Analysts fear that a massive sell-off of American bonds by China could trigger a sharp jump in the cost of financing for the United States. Such a move could crash the dollar, drive up inflation, and plunge the domestic market into a state of deep turmoil. In economic circles, such a scenario is increasingly compared to a commercial atomic bomb for the American economy. China, as one of the largest creditors of the United States, has for many years directed surplus currency from foreign trade to the purchase of American bonds. Thus, it not only financed the U.S. current account deficit but also ensured the safety of its own reserves. However, according to experts, Donald Trump's protectionist policies, in particular, the introduction of tariffs reaching 104%, have pushed Beijing to consider using its main trump card in the trade war. Rumors circulating in international media that Chinese banks have been instructed to stop buying dollars indicate a possible gradual exit of China from dollar assets. The current rapid sell-off in the bond markets serves as a convincing confirmation of the approaching storm. British media report a deepening sell-off of American Treasury bonds, which is pushing yields up and creating chaos on Wall Street. Donald Trump's plan to build a tariff wall seems to be transforming into a panic, the epicenter of which is the U.S. bond market. The threat of China selling American bonds has been discussed in analytical circles for several years. However, until now, Beijing has refrained from using this weapon. The reason is that a massive sale of American bonds could undermine the value of China's own reserves. Moreover, the economic interdependence between the two countries is so great that such a move could lead to a scenario in which both sides lose. Nevertheless, as autumn 2025 approaches, the tense atmosphere caused by the Trump administration's tariffs reaches a new boiling point. According to some reports, China has announced an additional 84% tariff on American goods, further escalating the situation ahead of a potential financial storm. The prospect of a major rift in economic relations between the two powers is clearly looming. Statements of intent to reach an agreement, voiced by one side, contrast with the ambiguity regarding the starting point for negotiations. The other side, in turn, sets preconditions, creating the impression that there is no room for compromise. In this escalating confrontation, the scenario in which one side might strike a blow on the financial front through a large-scale bond sale is becoming increasingly real. Whether it will decide to take such a step remains an open question. Some believe that such an action could have negative consequences for the initiator as well, devaluing its remaining assets. However, in the event of further escalation of the trade war, when economic interdependence is destroyed, one side may accept partial losses in order to put the other side's financial market in a difficult position. According to some analysts, the situation indicates that one side may have overestimated the effectiveness of its leverage, while the other side is ready to use its most powerful lever. However, China's actions may be just the beginning. The directive to Chinese banks to reduce dollar purchases could be a link in a larger strategy aimed at curbing the global influence of the U.S. currency. Beijing is seeking to diversify its reserves to protect them from potential sanctions and is actively developing alternative financial instruments, including the digital yuan. Thus, the current steps may not be just a tactical maneuver, but a reflection of a long-term strategic orientation. At the same time, U.S. stock markets are already feeling the effects of rumors of a possible sale of Treasury bonds. The recent imposition of tariffs has only exacerbated the situation, triggering a sell-off in the bond market and worsening investor sentiment. Many international funds, traditionally viewing bonds as a safe haven, have been gripped by panic. Concerns are related to the fact that a massive dumping of bonds by China will lead to higher interest rates and inflation, which, in turn, will collapse the value of bonds. This situation has not only caused a new wave of anxiety in the stock market, but has also begun to put pressure on the dollar's exchange rate. In this complex environment, the Trump administration is showing ambivalence. On the one hand, there are statements about the determination to win the trade war and the willingness to apply further tariffs. On the other hand, signals are coming from Washington that the door for negotiations with Beijing remains open. Analysts believe that a massive sale of U.S. bonds by China could deal a significant blow to the U.S. financial system, which, in turn, could push the Trump administration to a more accommodating position. However, despite the growing tension, neither side shows any willingness to compromise in the near future. Some experts regard the possible sale of bonds as a decisive tool of pressure in Beijing's hands. Although China has other levers of influence, such as the development of a digital currency and the promotion of trade in national currencies in Asian markets, it is bonds that remain the most significant argument in the dispute with Washington. In the American capital, there is a perception that such a move by China could provoke serious turmoil in the U.S. economy. Speculation about Trump's panicked reaction to such a scenario is increasingly appearing on social media. In U.S. political circles, there are fears that a Chinese bond dump will lead to a sharp rise in interest rates and, as a result, a recession. Individual congressmen are already warning the president, pointing out that further deployment of the tariff war could have unpredictable consequences for America itself. In expert circles, there are well-founded doubts about the potential effect of a large-scale sale of U.S. bonds by China. The total size of the U.S. bond market is truly colossal, and even China's impressive portfolio, estimated at between $900 billion and $1 trillion, may not be enough to collapse it. However, a sudden release of such a volume of assets could trigger a sharp spike in yields in the short term and destabilize the dollar. However, such a step will not be without consequences for China itself. A massive sell-off of bonds would inevitably lead to the depreciation of remaining dollar-denominated assets, which would negatively impact its reserves. In this regard, economists suggest that Beijing may choose a more subtle strategy, signaling the U.S. market through limited sales. This, of course, would not be a trade atomic bomb, but it would significantly exacerbate already strained relations. The Trump administration once explicitly warned China against such actions, promising to impose strict financial sanctions if they were implemented. Beijing's concerns are fueled by the example of the freezing of Russian assets after the start of the conflict in Ukraine. This precedent seems to be pushing the Chinese leadership to actively prepare and reduce its dependence on U.S. bonds. In the long term, a slowdown in the pace of U.S. currency acquisition and a shift to alternative financial instruments are possible, which would be a tangible blow to the dominant position of the United States in the global financial system. In the media space, it is widely believed that the protracted nature of the trade confrontation is fraught with a slowdown in global economic growth, increased inflationary pressure, and a reduction in consumer demand. Some experts even suggest that China may be the sole beneficiary of the tariff war initiated by Donald Trump. A large-scale sale of U.S. bonds could undermine investor confidence and create favorable conditions for the development of other Asian markets. Even attempts by Trump to ease the situation by temporarily suspending tariffs prove insufficient to stabilize markets. Bonds remain the epicenter of seismic activity. Analytical materials published by Reuters under the headline, "Why China Buys U.S. Debt with Treasury Bonds" recall that Beijing previously considered U.S. Treasury securities as the most reliable way to preserve excess export earnings. However, with increasing tension, the illusion of a safe haven has begun to crumble. Now everyone is wondering about the consequences if China decides to get rid of U.S. bonds. No less important is the reaction of other states that own significant amounts of these securities. Japan and a number of European countries fear being drawn into the chaos in the bond market. Rising interest rates in the U.S. could redirect global financial flows. Investors may conclude that risks in the U.S. have increased and reorient themselves to other markets. Thus, concern extends not only to U.S.-China relations, but to the entire global economy. Are we on the verge of a new crisis? History shows that a combination of trade conflicts and financial instability can trigger a global recession. The protectionist policies of the 1930s and the subsequent Great Depression serve as a sad example. Some argue that the situation is different in the age of technology, but no one takes what is happening lightly. President Trump's statements about China's readiness for negotiations, but indecision in starting them, sound like an invitation to a large-scale bargain. Public opinion wonders if this is a bluff on the part of the American leader or a firm intention to reduce the trade deficit. In response, Beijing sets a condition: the abolition of tariff barriers in exchange for mutual concessions. However, if a compromise is not found, China may resort to its main weapon, the sale of U.S. bonds. The scale of this step will be decisive. Will Beijing go for a complete sale of reserves or limit itself to billion-dollar tranches? In any case, such a step is fraught with chaos in the U.S. financial markets, a fall in the dollar, a rise in interest rates, and, as a result, an increased risk of recession in the American economy. Some experts warn that aggressive actions by China could backfire. However, the Trump administration's policy is increasingly pushing Beijing against the wall, forcing it to seek radical solutions. In this situation, a legitimate question arises: has the Trump team faced the prospect of a real trade atomic bomb? The prospect may be somewhat sharpened, but a massive sale of U.S. bonds by China is fraught with serious shocks. Many economic observers agree that the escalation of the trade confrontation has made U.S. bonds a target. Headlines like "Panic Grows," "Sell-off Accelerates," and "The Guardian" reflect the nervousness prevailing in the markets. Investors are hastily getting rid of bonds, fearing that a prolonged trend could shake the economic stability of the United States. Rising bond yields inevitably increase borrowing costs for the American government, creating a threat of inflation. According to social media analysts, this turbulence could trigger a deep recession as early as 2026. In such a scenario, even Donald Trump's electoral base would suffer. Beijing, in turn, emphasizes that reducing investments in U.S. bonds is merely a right to protect its own economic interests. China aims to diversify risks by instructing its banks to reduce dependence on the dollar. Simultaneously, the introduction of retaliatory duties, reaching 84% on American goods, indicates that a critical moment has arrived in trade relations between the two countries. While some analysts predict China will triumph in the escalating trade and economic confrontation, pointing to potential losses for American exporters in key sectors, Asian media tend to see this as a scenario of mutual destruction. Chinese exports are also under threat, making the situation a stalemate for both sides. Global financial centers are sounding the alarm, warning of the risks of a repeat of the 2008 crisis if instability in the bond markets continues. Observers agree that the world is on the verge of a historic turning point. The trade conflict between the U.S. and China has escalated into the financial realm, creating a threat of a global crisis. Some experts link the events to the policies of the Trump administration, believing that the White House may compromise. But so far the president is demonstrating firmness in his statements. Concerns are being voiced on social media that further delay in resolving the conflict could lead to serious shocks in the global economy. The bond market, which recently experienced a period of optimistic growth, faced a sharp decline after the new duties came into effect. Investors had hoped for a postponement or peaceful resolution of trade disputes, but their expectations were not met, triggering a wave of sell-offs. Forbes expresses concerns about the prospects for the American rally, pointing to the possibility that China will begin to dispose of its bonds. CNBC analysts, in turn, warn of a potential blow to the U.S. housing market. Rising bond yields could lead to higher mortgage rates and, consequently, lower demand for housing. Thus, turmoil in the bond market could trigger a chain reaction with far-reaching consequences. All these factors confirm fears that further escalation of the trade war could push the Chinese central bank to sell significant volumes of American bonds, which would be a real explosion for the global economy. In this tense environment, many are wondering whether the Trump administration will be able to stop this conflict. There are voices saying that China is also not interested in harming its own economy. However, the reality is that the atmosphere of uncertainty caused by trade duties has turned American bonds, one of the cornerstones of the global financial system, into an object of close attention and a potential target for retaliation. The growing tension in U.S.-China relations is causing experts to question the future of economic ties between the two countries. China's reduction of investments in American bonds, even gradual, could be a serious test for the U.S. economy. For many years, financial relations between the U.S. and China have been based on interdependence. However, now, as observers note, this connection is in danger of breaking, as neither side is willing to compromise. Such stubbornness, fueled by national ambitions, raises concerns about the possible development of a trade conflict that could last for several years. If China decides to take radical measures and start a large-scale sale of American bonds, it could trigger serious shocks for the U.S. economy and the global financial system as a whole. The question of how destructive this step will be and who will bear the greatest losses remains open. Escalation of the conflict will primarily affect the American market, but the global economy will not be spared either. In the face of increasing uncertainty, experts continue to closely monitor developments to promptly inform the public about potential risks and consequences. In the shadow of colossal tension, the international community is waiting with bated breath. How will the world react if China really decides on massive sales? Predicting the consequences of this step is not an easy task. However, one thing is clear: unleashing a trade and financial war is fraught with chaos in which there will be no winners. See you in the next